There's relief on interest rates for borrowers today, with the Reserve Bank cutting the cash rate for the first time in 2.5 years. Economists reckon it's a one-off, but that assessment could change rapidly given financial developments overseas. Here's Stephen Long.
All Hallows Eve, and Australia waited to see whether it would be trick or treat from the RBA.
We want money!
A little more cash for pagan celebration or paying off the mortgage. And sure enough, the candy came.
The RBA cut rates in a fine-tuning move today by 25 basis points because it took the view that with inflation coming down in the short to medium term, it was in a better position to actually align monetary policy with the outlook for a much more sustainable inflation outcome over the next couple of years.
It's welcome news for businessmen like Stephen Zeiger, owner of 3 hardware stores in Sydney. Like many retailers, he's seen highish interest rates and cautious consumers dampen demand.
That's fantastic. It's really, really good for the retailers in Australia. 0.25% means that customers will have more disposable income, which means more sales for retailers.
I think we could actually see retail sales go up if households do feel more confident about the stability of interest rates. And we have to remember that earlier this year there was a survey that suggested households were looking for rate hikes this year, not rate cuts. So even if there aren't further delivery of rate cuts from the Reserve Bank, interest rate stability at a lower level will be quite positive for expenditure, and I think will be good for businesses, particularly goods retailers, that is high street businesses going into Christmas.
But don't assume that this cut will be the first of many.
No, I don't think it will. The bank's still pretty bullish about the outlook for China and for the resources boom. And although it's not as concerned for the near term as it had been about the risks of higher wages in the mining sector spilling over into increases in the other parts of the economy, I think medium term those factors will still be uppermost in the Reserve Bank's mind. And so what they've done is simply bring monetary policy back to a neutral setting with today's move, but there's nothing in what they've said that suggests they're contemplating moving further to an easy stance of monetary policy anytime soon.
This is unlikely to be the start of a large rate cutting cycle. We really think this is one and done for the Reserve Bank.
Like Halloween, the threat is an import. The spectre of Europe's debt debacle spreading its contagion around the world and bedevilling the economy here.
It would take more ghoulish scenarios than have played out thus far. You'd need to see a serious seizing up of the European and possibly American financial markets, as others have warned, possibly zombie banks unable to lend, calling in loans from both household and business customers. Similar events on the other side of the North Atlantic, with America also falling into a second recession, with unemployment rising and with inevitable consequences for China, whose biggest export markets are the European Union and the United States, in turn leading to substantial falls in Australian commodity prices.
China's economy is softening. The latest official manufacturing figures out today suggest a broad-based slowdown in the pace of growth. And Europe's rescue plan is looking shaky. Greece's Prime Minister shocked the world last night, suggesting that Greece may hold a referendum on the deal to restructure its national debt. A move that could scupper the European bailout.
If we had the return of the evil debt in Europe, that would actually get the Reserve Bank contemplating and probably delivering more rate cuts, particularly if there was concern that that sort of wave of debt would actually spread through into our region in Australia.
Beware the evil debt.